That was you running the wheel?
Yeah. That's chasing you down.
I missed your class last week. No problem. I watched the video. That's okay. You know, I don't have anything to compare against that. This is my second class since being in school for 20 years. So this is my first class ever teaching. Okay. Then you did fine.
No, we're trying to hit a lot of topics. So, ask them any questions. I'll forward you the first ones via email.
Okay.
So, you probably got my email. And I've prepped for this class, so I didn't want to be distracted. Yeah, I'll see if you missed it. Just finish it up. So
Okay.
We'll bring it in.
Okay.
I'm not going to be here next Saturday.
We have a test next Saturday.
We have a test together, so.
I'll just need
Probably be like a first half of the class will probably be the test, and we're going to break everybody. Case study.
Okay.
Start.
Yeah, I mean, this is all, I have a construction background, so it's all new language.
Excellent. I'm going to be calling on you as to why we do.
That's when it's
The
best,
motivation
man.
is, yeah, you should have said that. Now you just teach yourself how to.
Hey, you were good on camera.
Oh,
I watched you on YouTube.
I get that a lot.
Part of it.
I get that a lot on these YouTube.
I need to get some cameo.
Yeah, you know. I try to make some appearances.
Is it on now?
Yeah, it's on.
Oh, okay, good.
What financial calculator do you use?
This is an 84.
Like 1984? Like 1984?
Pretty darn close. I think I was using like the 85 undergrad.
How are you?
Good.
Thanks for
Are we going to use a calculator?
For today's quiz? You probably log on to the computer that you want to use. Oh, there is.
Is he starting to like get the sense that you're warming up the Is he like pushing you down early or?
Yeah, no, I got it.
That's what my boss told me the other day.
Yeah.
My son just picked up.
Double salary is not bad.
I'm missing a couple more people, but we'll get started.
My sister and
So,
her husband.
kind of focus on chapter 12 today. We'll kick it off with very qualitative, kind of quick summary of 12 quiz. Again, no numbers associated with it, just kind of looking for, just kind of summarizing the main points that we want to really kind of cover in the chapter today. Just kind of conceptual overview. So, again, thoughtful answers. Exam next Saturday, probably going to be an hour and a half long or so, kind of covering a couple of chapters worth, but it'll be about 25% of the grade, overall grade, and so we want to be able to nail down.
And that's on chapter 11 and 12 and following reading?
Yep. And it's probably going to be more 11 and 12, just so that
Gotcha.
we've been able to talk through it. No, you're good to go. Resign the coaster. There's some, I don't know. Yeah, you're good to go. Sign up the co-star. I get a password. So he said, maybe you're ready. Ask if anybody else has been able to get access to it. All right, because yeah, usually once you sign it, you give you that student login.
Okay, I look, then forgot that I have to put an annual interest, total expenses, and vacancy appreciation. It's gross income or but it was, it's just tax away.
What would be, that's one that was the SKU that which runs with password?
Huh?
Does that make sense?
Yeah.
Yeah, I think you're good to go. I looked at it real briefly online, but I'll get you, or they get you some more feedback.
Yeah, there's something else. There's room, a couple numbers, dashboard, 3.
See if I can pull it up in my email. Someone's done it. This is more.
Is that the edge range? How do you like it?
I want to do this.
What's in now?
This is so favorable.
What is that edge part do for you?
Well, it does a couple of
Really? So you can actually,
yeah, it's just there. I'll wake up. The only thing I respond is a phone call. But I don't know what the timing is like between. If I right now, it'll pull up some notifications. That's awesome. Switch it over to notifications on. It's like a ticket type of thing.
yeah, that's cool, man.
So Olivia's not here. Is Chad here? No. Justin's not here. Olivia is not here as well. Okay.
Let me show you this. That's the old. My phone is maybe some Wi-Fi settings. But you like this look?
Well, I think one of my favorite designs is on the tailgate, the new
But I'll show you on my phone.
rest house. It's got this,
Yeah, I love it.
it's like a roof over roof.
Okay. Yeah. You can get it through floors. Okay.
Yeah.
Cool.
Yeah, big time.
He usually.
I go in and spend money on the floating stairs.
Yeah.
All right, let's jump into it. If everybody's got a second.
You think I'm alright, but a little heavy on the heart. Alright. Locks. Locks. Love you. Thank you.
All right, so some of you got all the concepts from the first quiz, some did not. We'll do a quick 2-second summary. The folks that submitted, because they missed last week, did pretty much good to go. Kind of tell you use some quick reference anyways. But benefits, basically what we're really looking for are just kind of the tax benefits, the predictability, quote unquote, predictability of cash flow. There were a couple comments, and I say comments because it really wasn't as an academic answer, but rents don't always go up, cap rates don't always go down, there isn't always price appreciation in commercial real estate. That's one passive benefit if there is, but really looking for the tax benefits, the predictability of income, and then kind of the management responsibilities, more the operational side of it and the tax benefits of it. Significance of a debt coverage ratio. Chapter 11 focuses on it as really what an investor can predict is their kind of quote unquote cushion from their NOI to their debt service obligations. Lenders say 120 in the book. I would say that's way too light. You're 130, 135, you want 30, 35% kind of cushion that as we just all live in the Great Recession is that 20% cushion wasn't enough. You saw rents take a 20, 30, 40% decline. And that's just rents. That's not even considering vacancy. So the people that stayed were paying materially less rent, and that's if they felt staying was worthwhile. So the vacancy is even a bigger hit. So debt service coverage ratio, really, last week was more for the investor and their cushion. Today we're going to be talking about the significance of it and the financial leverage side of it. So really a lender side. So again, I impress upon a lender saying, I want more cushion today than I probably ever wanted in the last, probably since the mid-90s. NOI, simply, EGI minus your expenses. So I threw vacancy in there, but that's already kind of assumed in the EGI number. So some people did back out the vacancy, but assuming your EGI, your effective gross income, already takes into consideration all of your pass-through income, vacancy, everything from really the income lines. So vacancy, if you get the EGI assumption, vacancy is already included. Is the short of it all. Taxable income is just simply, so really the NOI is going to be $500,000. Taxable income is going to be that NOI minus depreciation minus interest. So it's actually negative $312,000 in this scenario, which just, assuming if you just apply those numbers, you just think, wow, how can you have such a radically low and even negative taxable income? And it really is probably, I would say, a value add, very, very high basis, a lot of potential in a deal and early on in a tax return or tax filing year to be able to have that type of depreciation already. And then taxes affecting the value of real estate versus other investments. Can you guys all hear me in the back row?
Slightly.
Slightly?
We're working on reading lips, man.
Or you can move up.
Move up and I can take your seat.
Yeah, see, when I move forward, then I lose all the camera time. So
So
forget the camera.
It's important, man. This is good.
It's important.
Sandy goes over here.
So taxes affecting it, I think some people referenced real estate taxes versus income taxes. And the answer is, and so I probably should have specified actually a little bit more. But the theme of the chapter basically is, you know, the taxable levels of long-term cap gains, ordinary income, and then investors being concerned about market rents acquiring a property. I mean, I'll throw that to anybody else who wants to have the best answer for that.
Huh? What?
Robert.
Say that again. What? Wait, what? Wait, I wasn't ready. Say that question again.
Significance of market rents. Because it kind of flows in today's.
Before I answer, are you telling me that my answer was great?
Yes.
Okay, in that case.
Actually, I don't know if you want to read it word for word.
Oh yeah, so
No,
I
I'm
won't
kidding.
do that. If you
I
plan
don't
to
even remember what it.
plan your pro forma
Yeah.
off of, there we go, off of whatever lease you currently have, and it's different from market rates, or if market rates change over time, which of course they do, your pro forma could be way off.
Yeah. So even, and you're looking at it from a future perspective too. If you just take a snapshot of it today, and you have market rents, high end of market, above market rents, and you apply today's cap rate, I would even say that sometimes you know, there's immense pressure for growth in that investment. So the examples in all these IRRs is you're going to have like 3% rent growth and maybe 4% expense growth or something like that. Well, if you're already at the top of the income, there's nothing left there. So now you're just hoping that you're really going to be able to trim expenses significantly, take advantage of some of the taxable benefits, and there's really no room to run. So if you, both from going in today's themes, kind of just looking at it from a lender's perspective, you already have market rents. What else is left for you? I mean, hopefully market moves, but you're only going to be moving as well as everybody else. So you haven't really differentiated yourself or your product. So both from operational growth, value perspective, you really want to be able to, you want to be at market, but if you're significantly below market, that can be a big issue as well. I mean, anybody who can probably look at something just from a bare bones investment perspective, if you've got something that's significantly below market, what's the reason? Always consistently asking yourself why. Is it a piece of junk? Did something happen there? Is it irrelevant real estate? Is it falling apart? Is the roof caving in? Who knows what? So you really kind of want to be in the lower end or at market, but being able to know. And actually, some of you, I was talking about signing the CoStar. CoStar is a fantastic database, national database, where you can go and reference zip codes of market rent comps, sales comps, and also lease comps. So I know even for my own deals, okay, I talk to my guys, what does CoStar have to say? Let's go quick reference. It's not always perfect, but it's better than ordering an appraisal and having to spend $5,000 versus, yeah.
What kind of information provide?
In CoStar? Well, you can go by varying asset types and the rents that sales brokers and leasing brokers are submitting on behalf of those assets. So if you work for JLL and you're a leasing broker for them, and you just financed one of, I don't know, any office building downtown, if you submit the lease term and the rates and the structure for that lease, if you submit it to CoStar as a broker, you actually pay less to be a member of CoStar. So you're incentivized actually to share that that's how they can, kind of checks and balances to real solid information. So office buildings, shopping centers, and probably industrial buildings. They don't really do a lot with apartments, because that's kind of REE. REE has their own system. So that's just kind of hashing the quiz. You guys, yeah.
So if you had two buildings trading at the same cap rate, one had a lower market rents than the other, you're saying it's better to go with purchase a building with a lower market rents, or lower than market rents?
Impossible to answer. I mean, and the only reason is because there is a is a flurry of
I mean, just
questions to ask
conceptually though,
why.
like,
If they're two identical
Essentially,
buildings.
yeah.
well, not, yeah, I mean, and they're trading at the same cap rate.
Identical difference.
Identical in construction, height, location. I mean, there's just so many variables. You know, you could have a Walgreens on either side or two identical buildings, but I'll just kind of do Walgreens because they're single tenant net lease deals and same credit and same operation. You had one kitty corner of the same intersection, those deals will be materially different. I mean,
Traffic flows and things like that.
not even traffic, but I mean typically,
Deal specific.
yeah, they're very, well, deal specific in that the
Who negotiates better?
the formula to building it, yeah, and that's the thing. Well, it's going to be exactly the same construction. So
Yeah,
that,
right.
but the formula, those two pieces of dirt could be very, very different prices. So the one that's actually cheaper dirt may be motivated by a seller who wants to get rid of their entire real estate portfolio and not own anything anymore. Could have just given away in a fire sale the dirt across the street. And I'd actually buy that Walgreens because that Walgreens rent per square foot is going to be less, which is going to hopefully, relative to market, make it easier to re-tenant if Walgreens ever left. Okay, so if we just dumb it down to just single tenant net lease Walgreens deals, not two office buildings where it's multi-tenant, there's a lot more variables and the construction's the same with the Walgreens. Obviously, I'm going to want to try to be able to figure out what this unit level store sales are. Walgreens, unfortunately, doesn't report sales anymore. Next chapter, you go into a lot of lease structures, but they used to have leases where had percentage rent included in them. So if there was a hurdle for sales performance at individual stores, and if you exceeded the hurdle, you were doing so well, they actually shared those sales with the landlord. They don't really exist anymore just because they were paying so much money for their great locations to the landlord who had no involvement in the operation. That was just icing on the cake. They don't really do it anymore, but
Publix does it, but it's so high you never hit it.
exactly, yeah. So it's kind of a tease.
Right.
But some do.
Some do. Right.
If they,
Right.
but they'll always try to negotiate out of it if they don't even want to have to present it if they don't have to. So, yeah, but I mean, age of the building, the age of those two Walgreens are going to play a factor, because you're looking at the roof costs and things like that. So the short answer is hard answer or hard question to answer, but naturally, just quick gut, you're always going to want to shoot for lower rents. But it's kind of that risk reward surrounding who the tenant is. It's Walgreens who's S&P BBB right now. They're flying high right now from an operational perspective, increasing margins. It's a good story. I'd rather buy the better location with the cheaper rent, so that I can then have, if they do leave, like I said, you have an ability to either match market rents or have the ability to actually make some money on the rents. That's where your pop's going to be. I mean, that's when you can say, either I'm going to re-tenant at a higher rent, I have a higher NOI, value's probably going to be even tighter from a cap rate perspective, because you're going to have a new lease term that will give you, some more investment room. So you either refinance, take some cash out, tax-free, because you were able to create that value with Walgreens leaving and being able to lease it at a higher level. So you can take the tax-free money out, or you're selling it, and all you had to simply do was just basically strike a new piece of paper, with somebody else. So the effort involved, it is typically pretty low. But yeah, I mean, everybody's grappling with that same decision right now, because cap rates are so tight. Market rents have come back so fast. I mean, it's like a hockey stick from 2009 in some select markets. And so right now, it's what do you want to buy? I mean, where do you see more growth? And a lot of people are saying, well, I want land. The buildings are kind of tapped out a little bit because of what else I can do with some of the rent growth. But let me expand. Let me expand the shopping center. Let me expand Publix, let me throw $500,000 at Publix or something like that, give them some new lighting, giving them some new facade work. Let's see if I can extend their lease a little bit longer so that I can maintain that yield and push off having to have that representing conversation with them a little bit more. So, but I mean that's a good lead into ultimately financial leverage. As we talked about last week, there's very good leverage in income producing real estate. Some of the realtors in here realize that there can be very, very bad leverage in residential mortgages and residential real estate, because frankly, at the end of the day, it's only worth what someone's willing to pay for it. Commercial real estate, you can point to income production, you can point to motivations, you can point to pride, ego, who knows what. Why somebody pays what they do for something that is located where it is with a tenant of such credit, if any, and but still yielding a check, and you don't really hopefully have to babysit it too much. So we've seen some staggering. I was with the CEO of Storall Storage, who's in Deerfield Beach, who sold a portfolio of $430 million worth of storage facilities in the country to Public Storage. It's been almost a year and a half or so. And so Public Storage, the biggest, baddest storage REIT in the country. I mean, they don't need debt. They are just flush with equity. And it finally, the CEO finally told me how much Public Storage paid for his portfolio, and it was a 4.25 cap rate. Wow. And so, putting that in perspective, maybe a elevator infill location apartment deal right now is maybe like 4.5% in New York City. Just a staggering cap rate what they paid for this. But it's such a fragmented market, and he was grappling with me, a year and a half ago plus, do I refinance this because the market's come back, storage is doing great, do I just refinance this, take advantage of rates? I get to hold on to this, all my assets. I've got a huge team of people, like Terry, and what do we say, 350 people at Styles. Selling pieces of a business is basically, there's a lot of mouths to feed, but that can also be very, very profitable. So in that case, the 4.25 was such a staggering cap rate, was such a huge premium against that portfolio. He said, if it was 6, I probably wouldn't have done it, but I'll pay, because he wouldn't tell me how much he paid in taxes, because I was trying to apply that to my total. I was like, listen, I just got over a taxation chapter with a great bunch of students at Nova. Please tell me what your taxable basis was in this thing, because I'd like to be able to back into why you were motivated to sell at such a great cap rate when 39% of it was going to the U.S. government of those taxable proceeds and of the sale. And he just said it was worth so much more to be able to get rid of it. And I didn't mind. It hurt writing that check. It was like the biggest check I've ever had to write, and hopefully had to, and hopefully will ever have to going forward before he dies. But the motivations of theirs, a publicly traded REIT who has almost zero cost of capital, to 4.25 in a very fragmented storage space nationwide to be able to get great product. I mean, storage, they almost all look the same. They're all built the same. I mean, it's all pretty cheap. I wouldn't say exactly the same, but for the most part, depending on where you are in the country and geography and topography of it, I mean, it's all pretty darn cheap to build. So you're certainly paying up. But the financial leverage involved with that is he refinanced as much as he possibly could before that sale. It was all freely prepayable debt, but he wanted to be able to increase that basis to at least try to lower, that taxable income. We were talking about how much debt kind of applies to your taxable, taxable basis.
So what if you refinanced it to bring his cost up so we wouldn't have to pay as much in taxes? Can you explain that?
Right. So when you refinance, it's tax-free.
Okay.
So all that tax-free money was above and beyond his existing basis. So he, we'll just use round numbers. He went from $100 million total debt piece to 160, the 60 million was tax-free, but the 160 then he had to pay off, that 60 million delta was not taxable.
Gotcha.
Because you just saw, so if you have the access, which he does, to be able to do that, I mean, there's certainly strings attached, but it certainly was beneficial at the end of the day for him. We'll going right into, did anybody have any questions on the quiz? I actually want to address those because outside of, I mean, we're going to jump right into the test at the beginning of the next session. So I want to be able to kind of review this really fast. If anybody had questions on it first, yeah.
Can you go back over that tax thing, because I didn't understand that. So I understand the concept that you can get the 60 million tax free.
Yep.
But why is he not taxed on the sale? Is he still using the 60 million, or he's paying that off?
Well, he has to pay it off.
Right.
With the sale proceeds, but he's not getting taxed on it. So
why is it?
So say the sales proceeds were 300,
right,
and his basis or his debt total was 100. You'd be paying 200, okay? Or you'd be applying certainly mortgage interest and depreciation against that. We won't include those numbers in this example. But you'd be paying taxes against 200. Instead, he was paying the difference between 160 and 300.
Oh.
So
Was 60 the most you could get? I mean,
no.
Yeah, then why not keep going?
Why not keep going and get to like as close to that 300 number as you possibly can?
Well, then, good lead up. So through chapter 12, you'll see that there's certainly a cost of capital where that negative leverage is coming into play. So it's not the same exact interest rate at 60 loan to value, 60% loan to value as it is at 99.5% loan to value, or getting as close to the 300 as absolutely possible. So above and beyond, and so for storage, you're probably going to be more like 70 or 75% LTV loan to value. But if you needed to get any higher than that, and that coupon's probably like, the interest rate coupon's probably 4.25% today for that. But as soon as you get over 75 LTV, you're paying some, preferred equity partner, mezzanine financing to try to be able to lever it up. So the mezzanine was actually referenced in this chapter is basically an intercreditor agreement with the lender that is basically a secondary source of repayment. So you got to really get comfortable with who that mezzanine lender is, but essentially you're being able to pledge partnership interests in the equity, and it's not a secondary mortgage, a second mortgage or secondary financing. But that cost comes at like 10 or 11%. So there's a huge premium to borrowing that mezzanine financing. There's typically very big prepayment penalties. It's pretty stiff. So at some point, is it worth going out and getting a mezzanine loan up to 99.5%, getting as close to the 300 million as possible? But it's going to come in. You'll definitely have negative leverage in there. You're going to be paying more than your cash flow.
If you're sitting in cash on any kind of property, would you say it's wise if you can, if you don't have prepayment penalties, to always put money on something before you sell it? If you're able.
If you're able, it doesn't hurt, yeah. But then it also comes into play, there'll be some people who have properties free and clear that they've owned for 40 years.
Right.
I've been trying to convince my friend's father, who has owned shopping centers and apartments since the mid-70s. And he has a lot of this stuff that's free and clear. He's like, I don't have to worry about answering to any lenders, and it's super easy. And I said, well, why wouldn't you refinance this? He's like, I don't need the money, A, because it's cash flowing and I don't have to pay debt, so all of this is going into my pocket.
Right.
And he's depreciated it almost entirely. So at that point, his basis is so low, he'll never sell it. And he loves the after. I mean, there's no debt service, payments. So he just loves the cash flow.
Right.
So, but I kind of told him, so what would his motivations be to putting debt on it instead of selling it, because he'd be paying through the nose in taxes. in income taxes.
Well, if he put debt on it, wouldn't it increase his cost basis?
Mhm.
Wouldn't it be wise to put debt on it before you sell it then?
Yeah, but his basis in the property is so low,
Would be able to get one.
you're still gonna have a significant tax hit.
Even if you put some ridiculously stupid amount of debt on it?
Yep.
Well, by it being depreciated, you probably would be able to put a crazy amount.
The other thing is that too, so what are your motivations with that cash? So if you refinance your house and you have $100,000 of cash and you're just gonna have to increase your debt service payment, what are you gonna do with that 100 grand? Hopefully you don't go and buy a Bentley.
Right.
But you always have to have a higher and better use for that cash.
Right.
Again, what else are you gonna be able to do with it? So, I mean, and so in this example, it's like, I'm not gonna go and pay a 6 cap, or I'm not even gonna come close to paying 4 1/4 cap for a storage portfolio. You know, there's not enough value created. The market's returned so fast, there's nothing that I can really create any wealth with that money.
So at that point, all of that is capital gains, the entire sales price?
Yeah, after the first year. So, and depending on the size of the asset and your income tax bracket, you know, that's 39%. Worst case. That's a horrible check to have to write.
Cap gains can get up there, 39, I thought ordinary income's 39 maxed out.
Sorry, the ordinary, yeah,
Okay.
the cap gains is 20-ish or so.
So
Yeah,
would it
no,
fall in
ordinary-
cap gains?
Sorry,
It would fall in cap.
after the year, it would be ordinary income.
Ah,
Yeah.
When you say after a year,
But you have to hold it so that you're considered an investment, not just something speculative in nature.
yeah, but we were referring to somebody who owns something free and
Yeah.
clear,
Yep,
like they don't.
so that would be cap gains.
yeah, long-term capital gains.
Now let me ask you, if your intent as a developer, a lot of developments take, you know, say 1 to 5 years, you don't automatically fall in a 20% category. If you do it for a living, if you're a merchant developer, your ordinary income,
Correct.
right?
Yep. Yeah, which is, again, the motivations last week, you weren't here, but you know, you followed up with the reading, and that it's hard to sometimes stomach being a merchant builder. Some people don't want to hold it, they don't want to have the Terry Styles management, leasing, and you know, all these other mouths to feed to have a really comprehensive platform to really grow service fees and development fees, and then also the income from the real estate to boot. So if you don't want to build that out, you're almost forced to almost being a merchant builder. So
But
if
if
you're a great construction guy, you're a general contractor, you can build a fantastic product, there's always going to be people at some level who are going to want to buy that from you upon completion. You know, at CO, or whether properties, tenants are all in place, open for business, and paying contractual rent, when you can give them kind of full credit for that cash flow. Yeah.
But if you just managed and operated it for at least like a year, then you wouldn't be a merchant builder.
Correct. Well, there's a gray area as to how you qualify a merchant builder. I mean, most merchant builders have really great construction guts, and they have great site selection skills, and
Navigate the entitlements.
have great relationships. Last week we were kind of talking about do what you know how to do in your wheelhouse, be local, have a good vision for a property, tenant relationships, county and entitlement relationships. I have none of those. So by default, I don't build anything out of the ground, even though there could be some fantastic opportunities, and you can control your cost and control your yield a little bit better. But then there's going to be people who have probably better management, leasing, and operational skills than those that are merchant build in nature, that are really just trying to build a fantastic product.
I just say it because it seems to pay to make sure that you're not labeled as a merchant builder, so that you can avoid the
It's a pretty good label to
39
have.
versus 20.
It's a pretty good label to have.
Of course, but financially, when you have to pay taxes,
Tax-wise.
it's 20 versus 39.
It is a gray area though, right?
Well,
So
possibly 39, depending
Yeah.
on where you are.
Yeah, exactly, depending on where you are. If you're that good of a merchant builder, you're definitely paying through the nose. But I would say that merchant builders, Dustin, you built, and the merchant build by nature is.
But Dustin only pays 15%.
Yeah.
Ooh.
You can write up anything.
Take them to the hallway.
Truck equipment, I mean, yeah, you have no real expense.
Hold on, let's stop the camera before we really start
Yeah,
talking
no,
about
but,
that.
I mean, some merchant builders are very, very proud of building a great product, but they don't want to go and get permanent financing. They don't want to answer to tenants. They don't want to, take that operational risk. So, and I would say that even the merchant builders that I know and have done business with too, is that they don't really look at it from an IRR perspective.
Not at all.
They look at what their return is on cost, and they look at it from like a very whole dollar amount.
Mhm.
I can build this, and after taxes, I'm still going to pocket $300,000. But there's like no typically, Anthony.
Right.
Yeah, I mean, relatively speaking, they don't really care about yield. All they care about is really just return on cost.
Yep.
And again, how much cash am I pocketing after taxes?
Well, that's because you're holding it usually for less than a year, or the whole.
Depends on the project.
Yeah.
Many times it takes more than a year just to finish it, just to get to your certificate of occupancy.
But you don't start getting into like the IRRs and like
Never.
your kind of spreadsheet ends
It
at
does.
that. So at the end of the day, you're looking at the POM. There,
Yeah. So, I mean, yeah, not a bad label to have, but again, it's all kind of your motivations for being in the business, and if you're a robo builder for Dollar General, Dollar General gives their preferred contractors a region that they can find sites that Dollar General will approve, and you do a build to suit. 99% of the folks that do that have no intention of ever collecting a rent check from Dollar General. So they'll build it, get them in, open for business, lights are on, and it's on the market. And they're talking to Call Kane, they're talking to Stan Johnson, CBRE, whoever will take the listing and spam that offering memorandum to anybody and everyone to buy that that one-off Dollar General for probably $1 million, plus or minus. But you can do like 15 of those a year. So you can say I got a crew that can be 15 spots in any calendar year, and they can deliver them in 8 months, and clear $150,000 per property in 8 months worth of work. Maybe you can sell it, pre-sell it, in that same calendar year before, because people do like that credit, the BBB minus S&P credit for Dollar General.
Mhm.
I mean, that works. $1.3 million, and you have never had to take any operational risk. You got a construction loan, maybe you didn't. Maybe that's like the hardest part about the whole thing, typically, because they go up like that, super easy. So, and then you don't have to worry about, IRRs. You don't have to worry about leverage and finding out where the best mix is and tying up capital. That's the other thing too, is that you're tying up capital for however long you and your partners, if you have any, are looking to be able to contribute yield. So, but that's the fun part, So, let's take like a 5-minute break, because it's the top of the hour. Well, I think I know last week we just kind of ran through it because it's so darn hot in here, but let's take 5 like every hour or 10 or something like that.
Yeah, I like it.
What's happening? Sorry, I came in later. No worries. I know it's going to be horrible because it Are you Justin? Yeah. Sorry. So what I'm going to do is email you. Okay. Unless you want to do it right now. Yeah, we'll do it right now too. That'll be even easier. You might have to.
Yeah,
That's fine.
for
No worries.
Friday.
Yeah, so you can see up your Yeah, no, you can depreciate hard goods, fixed assets in there. You can, just kind of like a subject. You can depreciate all your furniture, fixtures.
What are you depreciating?
Yeah.
How do you use it?
Well, you don't. If you're the tenant, you don't have any of those advantages.
I always do the big thing.
Yeah.
No, I'm gonna ask my friend, because she works for the CBRE,
Uh-huh.
and she was telling me that I asked her, anytime you have a heating project,
Oh, yeah, but that says that. Okay, so that's two different, you're talking about two different scenarios altogether. So you're talking about the landlord getting advantages to building it, but you're also talking about, yes, the tenant will be able to realize, well, it's mostly just operational synergies. I mean, it's electricity, sometimes it's water, it depends on your LED.
so it depends
Gold,
on
if
the
you're
performance
silver.
of the building.
Yeah,
Okay.
yeah, so that's where you get the incentives by how much you're saving. It's almost like buying a hybrid car.
Yeah.
So your incentive is that you get to go through the express lane,
Yeah.
okay? But so from the tenant's perspective, that's almost the same.
I think
It's operational, not.
you cannot use it like as a depreciation or anything.
Yeah, and I think you have to accelerate, even if it's like solar, for LEDs and stuff like that, you have to accelerate that depreciation, because those solar panels don't last, they're kind of unique.
10 to 12 max.
Yeah, I don't know. You know better than I, but all I do know is that sometimes there's not enough solar around here because it's too expensive to realize the benefit from a landlord's perspective.
I was, I talked to her too, so I'm like, but I don't want to think about it now. Because
Now you have to incorporate in your case study, so I'm gonna hold it to you. So you have to do some more investigation, we'll get into that, but.
all right, I will, because
So you're gonna have to put a little spin on your specific group's presentation.
Thank you.
No pressure.
No more-
Only because I
no
don't
more-
know, and I want you to educate us all. I don't know the advantages operationally.
I don't
that
either.
a-
I mean, that's
that
what
a
I do.
tenant can
I
take advantage of.
need to, if I'm consulting for me. So, but I don't,
All right, you get the lead example.
and we're talking.
I was gonna ask you, do you have like a more detailed syllabus with description of the case study?
I haven't even finished it.
Oh, okay.
So, next Saturday, there'll be, like the first half of the class will be the test, and the last half is gonna be starting with the group.
So is there like guidelines for the test? And then it tells us the short answer, essay, multiple choice, all the above.
Qualitative, quantitative.
It's just those two chapters, 11 and 12, right?
Yeah, we might try to incorporate some in the next one too, in 13, but it won't be, 13 I don't think really goes into anything that is too, cause it's all risk, I'm gonna say. Yeah, I mean, it's really an extension of cash flow that you've already worked on. So, but it's really kind of determining, the kind of risk reward of those cash flows. So it'll touch upon it, certainly include it, but the bulk of it's gonna be 11, 12.
Okay.
But it's gonna be a lot more heavily financial too than what I've been talking about. So we wanna make sure that you guys are very much dialed in. Yeah. But, again, it's pretty straightforward. It's pretty straightforward, man.
Oh, I like the
Once
questions.
you got the basic, how do the formulas and calculations, all of it's the same. It's just doing it step by step.
Oh, yeah, I'll definitely hit that. I have a question,
Yeah.
but it's like residential, so.
Okay, you're the expert, not me.
No, yeah, right. But, okay, you know, kind of like that, refinance or whatever. No, you were saying that we sold it.
Yeah, it's different in resi.
Oh, yeah. So I was about to say like, what, short term?
It's a totally different piece.
Oh, okay.
Because there's no income production,
Right.
so you're still obligated to, and it also depends if it's your primary home or it's an investment property. So you still have the obligation to pay it back. And it depends, like your taxable income is based if you're married or single, you know, depending on how much you earn after the sale proceeds. It's totally different, don't worry about it. Well, worried about it because you're in business.
Yeah.
Don't, not for this class.
Yeah.
Quick question,
Yeah.
for the math, can you tell us for the test, what do we need to know for the test? Yeah. You know how there's like the taxable income, like how to get to that, or, you know, for this chapter two?
There'll be a lot of assumptions though, you see, you don't derive it.
Okay.
I just want you
They know it.
like the first quiz, how can you interest, I know when you derive it, so it's a lot of time.
Right.
That's why.
But I want you to really just be able to understand the numbers that are the applicable numbers for before and after tax, you know, IRRs. But I know you pretty much have done that in your previous
Yeah,
sessions.
some people have finished.
Yeah, but it'll be, I'm not gonna make you like, give it a blank Excel and create the whole thing from scratch.
Yeah, because the
That's
chapter
the-
has a lot
that's the next
of
one.
charts.
Yeah.
So I don't, you know what I mean, like I wanted to take notes of the chapter, but I don't know which chart to go by. Some of them have.
All of them.
income.
They all flow on the same thing. So a lot of the charts you'll see are previous chart plus. So you'll have like deriving, you know, deriving taxable income, and then you're gonna we'll have charts in between there, the depreciation, the interest, the rest of the positions.
Okay. All right. One thing is that
Yeah.
Another country, and I'm here, and she was like a shadow. But this is my personal life. I got nothing for the first line. No, because my the first day I was blessed and pay a lot to be here, but in a way that this is not. We started at 8, I have another class and I got at 6. And the first day I did it, I cannot do it. Why the class is way is not the main campus, it's this way, and also I have to say first. No, it's one thing that we can talk about with, I know that.
I think it's just a Saturday.
No, but I took it my weekend, the master. I was confused on that too. Now I know, because I am here, so for 2009, I started to be the master. Okay. I well, with glasses here.
So in the other classes, you're having PowerPoint, a lot of computer track.
That I took it.
Yeah. Yeah.
Not in this program, because I did my master's in international business, different things. Or we can have PowerPoint, can follow the.
Yeah. We can do that.
My opinion. Another thing, the quiz, the
It's an extension of that, and maybe with some more.
That's
That's okay, I got this.
This is a lot of.
this kind of different shots. Oh, I have the same here. The range of memorize nothing. And in the classes that we have three rounds and one cases and it's not a prerequisite. If it is, but you understand what I said, because I have the name of the grade is not different. Oh, whatever. But there is a rules. I don't care.
How's it going, man? Hey man, I sent this to you before.
You emailed it to me?
Yes, I emailed it to you before, man.
Oh.
My bad. You're terrible.
Well, project descriptions of what we're doing.
If you go on that one you'll see the urban plan handbook, and you'll see all the stuff like you should see all of it up there.
That'll get you to speed.
Yeah, you do need to read through the urban plan handbook.
Okay, by next Saturday.
Because I think he's going to throw a quiz at us or something like that. And there's a bunch of questions at the end.
And we're working on the project next Saturday.
Yeah, we're going to be working on it.
I don't know, maybe you said cases where to approach one exercise that started with the case. You understand that?
You went on Argus and played around with it yet?
Yeah.
It's nice.
Yeah, you understand.
Yeah, it's fairly simple.
Now, so is Argus just a straight up replacement for Excel spreadsheets?
Expensive for you?
I wouldn't say that.
No.
It has the components of it.
DCF.
Yeah, it's like Argus, you don't have to build this spreadsheet.
Right.
Evaluation, I've only gone through the video.
The developer one you've done already, right?
Yeah, I did the developer.
So that's simply like an IRR spreadsheet or?
Yeah, because you can put in everything.
So it's just a dummy proof
Yeah.
spreadsheet for a developer.
Yeah, Argus developer is actually seems to be a great tool.
Right. So you can either build it yourself in Excel for free, you have the skill, or buy it through Argus.
And put it, have it all rolled out for your.
Gotcha. Cool.
This is my opinion, to be more smooth class, maybe the native English speakers, like if you speak Spanish, for sure they understand the back or not. Maybe the other one thing also the voice
There's dust looking, so it's supposed to be
Because some professor might be
that will come.
right
there,
if I got
30 days.
check again,
You know,
and it's my positive feedback. It's not a claim at all. It's only positive that based on my experience. So working my life in the, I said in the street. I never know what to say when it goes to the street, university.
You are a smart guy.
Okay, but you understand. I can understand that about it. No, okay, today's the day.
Actually, it's like, I know it's a, but I want to be able to see how.
No way to see.
No way to see.
That last project you had to do was bullshit. It was all busy work. The case study, second case study. Yeah, that's bullshit. It's crazy, you know? I was sitting there in my hotel room after I worked all day till midnight, you know, cleaning all this nonsense. If it's important shit, I'm learning, it's great. It's in my own work shit. It's like, come on, this is my own work shit. Right. Go to the internet, Google search, I learn it. Yeah, whether I write it or I see it, it's learning.
All right, so I have a quick question. Yeah. I'm extremely nervous. Give you that exam. So that last one you gave us. My problem is like no. Okay. As our warm up, or yeah, that's yeah. What am I doing?
We're out of town.
Test.
Hard notes, you gotta have what you know.
I mean, typically, you would be.
This makes me more second. So
At least here, I was able to give them to you.
I mean, I know I'm not worried that we're gonna be sitting here like face
There's
to
gonna,
face.
so, in chapter 11, there's gonna be a lot more. Assumptions is kind of like any year. I want you to read the things, mortgage balance. I want you to have to give you a lot of people out while you're figuring out this. I'll give you assumptions. Here, like the vacancy, it doesn't even play. You already have the GR takes some consideration. I'll give you those assumptions.
I just like that in perspective. This was easy,
That word. Well,
I'm gonna get about it from time to time, but
yeah, because this is all new. But yeah, I mean, ask a lot more questions. So, I don't know about the calculator. I have one of these, so I need it, especially when you 12, like, you're going to be creating
like I'll show you.
And this is all on itself. Most of it's going to be fun now. It's going to be concessions. It's going to be okay. So it's good. Like, my problem is like 40. I can get Rana answer without being informed. It's just breaking it down. It's like you said, it's like common sense basically.
In the greatest spreadsheet with everything just kind of memorized. And the dates that they want you to like here, you got the new dates, reports that it's related to, and what the assignment is.
You need to know how to get
And whether I keep track the whole way through, I just tracked it, whether I did it, how did it, it's great, just to kind of give me a quick look at what I need to be working on in weeks. So like this week that just passed, we got
because I read, remember last night I had fun having that, and
I looked at it as
wasn't
our
bad.
actual state accounting.
But when I went back to the previous chapters, I was
I gotta make sure I have read chapter 4 by then.
I mean, worse
And
than
then
this.
just class 2. And 6 I gotta make sure I have read chapter 12.
Yeah, I was worried. I was like,
I look at this towards the end of the week, right after class. I'll kind of plan out my week. Like, all right, this is what needs to be done. Like, there's even
It's hard, yeah.
After like 3 or 4 times projects that we got.
But this thing,
But it's just no.
we're gonna go up to underwriting. That's a little bit. 13 is like always risk.
No study. But no, in reality, it depends on the course. Because like that's the lesson I'm going to do. So I spent little time out there. I can't wait. Which was the year, the course we did tax market.
All right.
This one probably.
So we're gonna to start tracking kind of like the second segment. We'll knock this out, in 45 or so. It's starting on 392. And everyone has the book now, right? Okay.
What book?
Don't say that. I'll sit up front here first. So, did Antoine leave? No? Is he going back?
Yeah, he said he couldn't take this anymore.
At least he has air conditioning. Is now kind of looking at the how to kind of create financial leverage. So the leverage is ultimately kind of the benefits that investors, the results of the investor benefits above and beyond what they can borrow for positive leverage in their investments. Only kind of enhance the IRR returns and how you can focus specifically on.
I'm here.
There he is. He changed his mind.
Are you not going to sit in that desk? You're not? Elena, do you want to move this desk up front then so you can listen? Antoine said he's giving up his desk to you. Yeah. All right. Thanks, guys.
Right next to you, buddy.
Come on, right here. We can be desk buddies.
Thank you.
Right, I hope, you can sit next to me.
Now, if I have any questions, you have to. Oh, you need a chair?
No.
Just stand.
All right, so the financial leverage, loan to values, chapter 13, which we'll touch upon in the, next week and also in the exam, is kind of the risks associated with the leverage. But more leverage, as we've talked about, isn't always better. And it's a function of both the leverage and also your debt service coverage ratio. So, Anthony, debt service coverage ratio, where's the best mix of LTV and debt service coverage ratio?
For what I do, you're saying?
Yeah.
I'm the worst one to ask because we don't use debt.
70-30.
Why?
I'll tell you from my experience.
What's that?
From what I've heard, it seems to be 70-30 as the one of the best mixes.
It's decent guidance, yeah. I mean, you're going to have enough hard equity commitment, that 30%, and you'll probably then, depending on where your cash flow is going to be. I mean, it's also a function LTV and debt service coverage. Again, where that cushion is going to be. The 130, you're probably looking more like 65 to 70.
65
I would say.
on LTV?
On LTV, yeah.
Just a quick question regarding the mezzanine financing.
Yeah.
I know
We'll get into that.
Oh, we're gonna
Hold off on that, but
okay.
you can introduce mezzanine and preferred equity.
Oh, great.
No, but Robert, okay, so debt service coverage ratio, define, kick us off.
All right, it uses the acronym DCR. That's you want more than that? All right.
Yeah.
All right, so it essentially is the rate in which your NOI is covered by, or the DC, I mean, the debt service is covered by the income of the property.
Right. So, you have a question?
No, I'm participating, I'm listening.
You're here participating.
Yeah.
Should mark it.
All right. So you'll have, you know, leverages are going to go up to 90. Leverage debt service coverage can go down to 1:1. I think it depends. I want to introduce a couple concepts on kind of the underwriting functions of a recourse loan versus a non-recourse loan. Your merchant builder is probably going to be recourse, which is going to require personal guarantees. And with that personal guarantee, and we'll touch upon this extensively going forward because it's also kind of a big risk-reward function. But if you can pledge your personal guarantee, your cash flow, the skin on your back, you're probably going to be able to borrow more with it. Because that takes into consideration your resume, it takes into consideration your net worth, cash flow, earnings. You're probably going to get better leverage, you're probably going to get a tighter debt service coverage ratio because it's another personal level of repayment. The non-recourse loan, which was pretty much invented in the mid-90s, is basically saying that I'm going to look and point to the performance of the asset by itself. Okay? No personal guarantees. Robert, you don't have to sign your name.
Why would a bank really be interested in that? To not have a recourse, so to speak, besides the property?
Competition.
What's that again?
It's just competition, right? Like one bank says they're not gonna do it, more people go there, and the other banks,
Well, why would any of them say they're not going to do it?
they get more business.
More business. They're maybe more comfortable with real estate assets to backstop.
So is it that they're willing to accept? Because I always hear banks saying that, hey, we don't want to be in the business of owning real estate or anything like that. So why would they allow there to be a non-recourse loan then?
I think it's going to be a couple of different reasons. Typically, your non-recourse loan is going to be for a stabilized asset, stabilized NOI, predictable NOI. You know, after a couple of years of ramp up leasing, you've realized probably one of the major highlights, benefits of owning and operating commercial real estate is that you have that lease income, you have that predictable income stream. So once you can find that predictability, it's what are you bringing to the table, you know, personally after that. The property hopefully is a little bit on cruise control, you know, outside of kind of market items you can't predict, and you want to be able to think that if you have to take back the property, because a non-recourse loan, again, is you can throw back the keys whenever you want to. Okay? If you want to walk away from your equity, if you want to walk away from the responsibilities and move to the Bahamas, you can walk in. I mean, my clients can walk into my office and throw me back the keys.
Yeah. Will you, what to say, you off?
What's that?
When you return the key,
Well,
you off, their name, you off, I don't remember.
Yeah, so it's typically, you're going to set up 90% of plus or minus. Property owners are going to be in limited liability companies, single purpose entities, okay? So that single purpose entity, which is bankruptcy remote, limited liability company, no personal guarantees. I mean, there's usually managers, managing members, and members that make up that. But they can all come in and say, we don't wish to open, or operate and own this property here. Here's the deed. It's your responsibility now, Mr. Banker. You can figure it out. We're out of this thing. Which was the windfall of properties that were happening in CMBS and the life company world during the recession.
And I don't know if we know in the not even know in commercial, but in residential, the board in the community if you have a property under the name of the company, you need to sign for the maintenance as a person, your liability, because you know what happened in
Not
the
here.
crash. Not in commercial?
Not in a non-recourse
because-
loan.
No,
So, yeah, if you feel like.
that is new.
Well, newer since probably the mid-90s, yeah. I mean, it's been
Exactly.
around for a while, but formally and legally, and now it's pretty much almost a business standard for
Okay.
a permanent loan. You know, it's gonna be a 5, 7, 10, 15, 20-year fixed rate loan.
Yeah.
So, you can anticipate the bumps, but you've already gotten past the ramp up. But where I wanna go with that is, the non-recourse loan is probably going to require more equity. It's probably going to require a higher debt service coverage. We'll bring in the mezzanine. The mezzanine loan kind of bridges a little bit of that in a non-recourse loan. Higher leverage, lower debt service coverage, maybe down to a 1-1. But in terms of all the comments that you guys were making too, it comes with a cost.
Yeah.
I mean, that mezzanine financing can sometimes be 12%. It significantly can cut into your positive leverage, easily. When your first mortgage is 4 1/4 and you're buying something for 6%, your mezzanine loan because you're equity constrained, or you just feel like there's maybe so much more upside in a property that it's worth paying that premium for. And it burns off. I mean, you can always sometimes pay it off a couple years into it. But it can be extremely expensive. So you don't have to have it, but if you need it, many times it's there, but you're certainly paying a premium for it. Can you say something?
No, I was just thinking about something. I mean, typically you guys have, when you go to lend to specific borrowers and developers, do you have a set of guidelines, or are you pretty flexible depending on your level in your organization?
Flexible in deal structure?
Yes.
Well, yeah, I mean, it depends, and that's
Or are they
probably a
really
good
give you
entree
A,
into
B, C,
the
or
types
D?
of financing that's out there. So, I mean, you can go to a bank balance sheet, you can go to, Bank United, you can go to, I think there's a Seaside Bank branch, Wells Fargo,
Right.
those traditional regulated banks. They are probably less flexible, just because we're getting incredibly regulated as an industry right now. Whereas much as I'd love to be flexible with you,
Right.
the reserves I have to take back because the Fed says they don't trust me
Right.
to lend money to certain people, no matter who it is, you're gonna have to probably reserve 150% of the amount of a ground-up construction apartment loan right now, mortgage, for no reason whatsoever. I mean, you could be the biggest and baddest apartment guy on the planet. I still have to reserve 150% of that, $10 million loan or whatever. I have to reserve an extra $5 million.
So you gotta go find it elsewhere.
So, no, but that limits my flexibility to you.
Gotcha.
So I can maybe price it a little bit more aggressively if, to win it because of competition. But my hands are a little tied in terms of leverage.
Oh, when you say 150%, you mean you have to back it up by another 50%?
Yeah, so I mean, banks you'll see in our Basel, or, all the Basel and, what's the other, Dodd-Frank. I mean, you're gonna be now tier 1 capital constraints with all that reserved money for your exposure to, in this case, real estate.
Gotcha.
Okay, so, yeah, I mean, there's a cost of doing business with you, and there's a cost of, me putting that money to work.
Right.
And it's, if I want to put out 10 million bucks, I got to reserve 15.
Right.
I mean, there's really not a lot of positive leverage in that,
Yeah.
but in many cases, but you're getting paid for it. It is accretive, and pricing has.
Now, since that's more
jumped up
speculative,
since.
would you say a commercial piece with leases signed would be a lot less stringent?
I mean, yes and no. I mean, because you're pre-leased, but all those can fall out of bed
True.
tomorrow.
Right.
I mean, if there's so many pieces you can't
Clauses and
control.
shit, yeah.
And there's always a little bit of a bucket set aside, you know, in those regulated banks too, to be able to do more flexible stuff.
Right.
And say, okay, I will maybe do something higher leverage, and I might have to take even more reserves back, or I might have to charge you a point to cushion that reserve or something like that, so I can, and that's not even trying to make money doing it. I mean, that's just trying to figure out a way to make it worthwhile, you know, as a bank to put out money. Which is the bigger points to the banks down here. I mean, during the recession, they had no money to reserve to do new business with, so you might as well just fold up and call it a, you know, or sell to somebody who's better capitalized, that can stomach those reserves, that can stomach new business. That was a big stumbling block. It still continues to be in some cases too. But outside of that, then you can get into the CMBS market, and we're going to reference a lot of these. I'll actually probably focus a lot of this on the test too. Is the alternative sources to the traditional bank, okay? And I'll circulate this week, and probably this weekend, to everybody via email, this CMBS e-primer, which gives you, you know, essentially all the background to originating, creating the REMIC, or Real Estate Mortgage Investment Trust, and then being able to how these bonds and securities are sold that are backed by income-producing real estate. So the CMBS side of it is basically going to be taking the AutoNation building, you know, we'll just use round numbers, financing it for a $50 million first mortgage, you know, non-recourse. It's probably the best and highest leveraged and priced mortgage product on a non-recourse basis in the marketplace today. But you bundle that up with $1 billion of other product, okay? And then you can basically create a trust.